So eEnergy came to the market in January of this year, and we came to the market really for two reasons. One, to create a vehicle that would be a consolidator and a buy and build vehicle for what we see as a very fragmented energy services space, and to raise some capital to drive further growth in our core business. I should just say that my track record in buy and build has been proven on AIM before. I successfully listed a business in 2002, and after 9 acquisitions, sold to Trinity Mirror in 2006. So it's a very exciting opportunity now to do something quite similar, but in the energy services space. So our core business is in the energy efficiency as a service sector. What that means is energy efficiency as a service drives energy savings to customers for a monthly subscription service, therefore avoiding the need for upfront capital on high capital expenditure on energy projects. Our core business, eLight, uses LED lighting as its core technology, and so we therefore drive energy reduction for our education clients, principally schools, and our commercial industrial clients through the use of LED to drive down energy costs through a monthly subscription fee, whereby the savings that we unlock through that technology is more than paid for by the savings, therefore leaving a surplus of cash every month for those customers. So in effect, our customers can unlock cash flow, reduce their carbon footprint, and drive down operating costs through the move to LED lighting. The business has seen explosive growth over the last year. In the last quarter, we're up 500% year on year, and we're seeing underlying organic growth of around 350%. So we're really excited about the prospects for the company, and we're seeing huge amounts of opportunity in the education sector, which is a massive addressable market for us. The schools market comprises of about 27,000 schools. 80 to 90% of those schools in the market in the UK and Ireland haven't moved to LED lighting. So this is a market that's worth £1.5 billion. Our goal is to capture 10% of that market in the next 3 to 4 years. We're also focused on some very niche commercial sectors, such as food services, healthcare, and distribution. These are sectors which have been, if you like, benefited as a result of the COVID, if you like, the COVID pandemic, which has driven operating hours in these sectors. And we're seeing a lot of legislation drive the need for energy efficiency in the environment that we're in, where people seek to hit that net zero target. In terms of our broader M&A strategy, we have a really mature pipeline of developed opportunities. We're looking at a number of sectors that are synergistic to eLight. And in main, really, we're looking at the energy management sector, which is the energy procurement brokerage sector, which has a huge amount of opportunity for us in terms of acquiring customers that we can upsell to through the energy as a service offering. So in summary, we've got a really compelling business model. We've delivered over 1,000 projects. We're seeing 350% organic growth. Our core business is profitable. We've been profitable now since April, month on month, and we're aiming to achieve break-even post-group operating costs by the end of this calendar year. Just in summary, for those that aren't familiar with energy efficiency as a service, let me just talk you through very briefly how our business model works. In essence, we have a 3-stage process. We identify our customers through a variety of, if you like, new business win strategies, such as digital engagement through social, through online search, and through various forms of direct marketing. When we acquire a customer, we are looking to engage them with an independent survey that drives a lot of data out of that customer, so we can understand clearly what their current energy costs are. Our proposition to them is very simple. For no upfront capital, we're able to transition that business or that business organization through LED technology, which enables them to transfer the risk both technically and financially of moving to a retrofit solution of LED lighting, and they will unlock free cash flow from day one. So it's a very compelling proposition, and I'll talk you through what it looks like for a customer in a minute. But typically, a school will typically unlock somewhere between £15,000 and £20,000 of net free cash on an annualized basis, and over a 10-year horizon could be looking north of £400,000 worth of net cash savings. So it's a very, very compelling business model, and we have a very unique go-to-market strategy. We have a strong referral network. We have lots of multi-channel partners, and generally speaking, we have a very, very mature pipeline in terms of how we're addressing the market. In terms of how we make our money, we are essentially working with a panel of funders who are dedicated to supporting eEnergy and the eLight proposition through effectively SPVs. We sell our contracts, so once we've secured a contract, we essentially sell that contract to one of our funding partners who pays us a net revenue figure for effectively the discounted value of that project. So we are cash flow positive. We don't take balance sheet risk. We don't take credit risk on the customers, and we are cash flow positive in the month of installation. In terms of the drivers for our market, we're now seeing two very, very clear drivers. One is a regulatory driver, which is an overall compliance, everything from carbon emission targets through to EU directives that are driving public sector or commercial organizations with a need to drive down energy costs. And we're seeing commercial and social kind of drivers, everything from failed old infrastructure being one of the most common drivers that we see. The need to reduce carbon footprint is increasingly the #1 agenda as well. The opportunity to release cash flows without deploying capital is clearly a powerful driver as well. We have an innovative operating model, and there are sort of three parts to our operating model that we call our secret sauce. With any energy efficiency project, unless you are measuring the detailed consumption before and after, which is a very costly and expensive methodology, most energy efficiency projects rely on deemed savings. In order to ensure that the customer is very comfortable with the proposed savings, they've got to get comfortable that you have been able to be accurate with their existing costs, accurate with their proposed savings. A lot of people think that in order to do an LED project, it's simply a case of counting what you've got and replacing them with an equivalent. Doing it that way is incredibly inaccurate. So we have developed a proprietary IT platform, which constitutes a bespoke proprietary app, which enables our qualified surveyors and outsourced contractors to essentially capture data on site, which is a mixture of the inventory of equipment, i.e. old lighting on site, capturing the heights and the existing light levels within any one room, and making sure that the operating hours we capture in any one particular room where there are existing lights is done specific to that room. So we are building up a picture which is captured in a step-by-step process which eliminates human error and allows us to capture into the cloud accurate data. The analytics engine that we've built then specifies from a database of equipment the right specification that's going to drive the maximum amount of energy savings, but precisely the right amount of light that that particular room needs. So we don't overlight or underlight any one room that could either compromise savings or compromise the operating performance of that room, whether it's in a factory or whether it's in a classroom. The client sees an automated proposal that's both accurate, transparent, and allows them to make an informed decision very quickly. So that process does two things. One, it provides trust in our client offering. It also allows our business model to scale without the need for costly and onerous design and specification, if you like, resource in the form of lighting designers and specification engineers. So that is a really powerful tool and will enable us to scale in particular in one of the unique areas that we're looking to scale in the SME market. The second area where we're driving value and have a unique proposition is around how we procure our equipment and the price at which we procure our equipment. So we're not a lighting manufacturer. We don't procure our equipment from China, so we are absolutely obsessed with quality, but it's very, very important that we're able to create a value proposition for the customer. And in doing that, we have secured exclusive pricing from 3 of the top European manufacturers of LED lighting equipment. And that pricing, which is exclusive to eLight, is in between 20 and 25% below wholesale pricing. So that allows us to present effectively a funded lighting solution over 7 years for broadly not much more cost than if the customer was to go and choose to do it themselves, you know, with open market pricing, using contractors, and either using their own capital or using asset finance. What it means is that they're effectively buying into this no premium concept of amortizing out through savings over a 7-year period rather than deploying their own capital. So it's a very, very powerful proposition. And indeed, what we're looking to do is over the coming weeks, actually secure a further level of exclusivity with one of our partners that will actually end up co-branding products specifically for us that will give us a much more vertically integrated and even more powerful proposition. And then finally, one of the complexities of energy efficiency as a service contracts is that the paperwork can be quite onerous for our customers. So we've worked very hard to create a simple one-page service agreement that navigates through a lot of the new accounting regs to enable for our commercial and independent schools a solution which is off balance sheet, which means they're able to recognize the savings against their P&L costs, and they don't have to amortize the capital cost across the balance sheet. So that's a really powerful proposition. And on the state school, academy, school sector, what we're able to do is we've created a contract that is a compliant contract that allows a school to engage with us, because traditionally schools are precluded from signing finance agreements. So we've created a bespoke product that is DfE approved and which is qualifying in the compliance guidelines that schools are bound by. So it's again a very unique proposition. It allows us to provide funding into schools, which is otherwise a very difficult sector to fund into. Here is an example of what a client sees. It's a very simple proposition, and behind which sits a very complex set of financial and energy saving analytics. But our job is to make it easy to understand for a client. So here you can see in the current column, total existing lighting costs, and this is a live case study for a project we have delivered, that this particular school was seeing that their existing lighting costs were just under 78,000. By deploying the LED technology, which is an optimized solution, those utilities costs for running lighting will come down to, as you can see in column 1, 26,000. That will rise with inflation at a 5% index escalator, which we consider to be conservative based on future projections for energy prices, which are almost double that. You can then see the fixed costs, the fixed annual costs, which are monthly payments to eLight over a 7-year period. And the light green line is the net cash which this school will see unlocked to its organization from day one. So over the course of the 7 years, this school will be unlocking over £211,000, and over a 10-year horizon, they'll be unlocking 437,000. Now, this is an incredibly powerful proposition, and this is the reason why we close 40% of our proposals, because outside of the financial proposition, our offer is both compelling, meeting an active need in the market, and we have a trusted and credible track record with huge amounts of referrals for schools to take up on. When we look at our contract economics, you can see here, this is the same contract, and here what you can see is that the total contract value would have been the 7 years worth of fixed payments that the school makes to us. We sell this contract for 85% of its value to our effectively funding partner. So there is an implied 15% total cost of finance, and we recognize as our revenue the 85%. Within that 85% is both the hard costs and the soft costs of delivering the project, which, as you can see here, is the technology costs and the installation costs, releasing what is our gross margin. This payment to eLight, the 85% payment, is made the week following or the week of the installation being completed, and our supply chain are paid post that event. So we have extended third-party supplier payment terms, which allows us to be cash flow positive post installation, which is a fantastic business model because it releases cash almost in parallel with our P&L. So we have a positive cash flow model. In fact, our gross profits now are averaging 35.5%, and we're on a trajectory to get them to 40%. In terms of our strategy, there are 3 levers that we're pulling at the moment to drive growth in the core eLight business. One, our direct sales model is now both, we have a large pipeline of over 100 projects that are sitting with decision makers. And as I've mentioned, we have a 40% conversion rate, and this pipeline is currently sitting at over 20 million. In addition to that, what we're seeing now is that a lot of our school opportunities are multi-academy trusts, where you have one decision maker who is sitting over a multiple school portfolio. So some of our new multi-academy trust project values are looking north of £1 million. So we've got an existing large pipeline, very targeted marketing, and we have I guess a market we're selling into now which is very active. 2 to 3 years ago, I would say the market was more passive, where we were educating them on the concept. Now that energy efficiency as a service is more commonly talked about in terms of how to move to renewables and how to move into energy efficient technology, because we're the dominant player in the education market, we're starting to see more incoming inquiries, which is fantastic because schools is quite a closed community. In addition to that, we are talking about some very, very large commercial multi-site projects. To give you 3 examples, we're working on a joint venture with a large lighting manufacturer who has outsourced the project to eLight, and that is to a 2,000 branch network for a high street bank. That project, if we are successful, is worth over 20 million. We're working on a national rollout campaign where we're one of 2 competitive bids for a national pharmacy chain, and again for another food retailer of over 600 units. These key account opportunities are not currently in our forecast, but if we win them, there is a material shift in our P&L for that year, because each one of these opportunities is worth several £1 million. But suffice to say, we have been selected, invited, or we have partnered, and we have a very active role to play in those bids. So we're excited at the prospect of some of those commercial opportunities. I talked a little bit about the eLight app. What we are looking to do is we're looking to license this app to our approved contractors so that they may be able to directly sell into the smaller schools and the SME market. So we have trained up our contractors on how to use the app, and by the end of the year, what we're looking to do is we're looking to release the second version of that app, which is a full turnkey solution that simply put, at the end of the audit, the contractor is able to present via a PDF screenshot the live proposal from the audit and PDF send a copy of the contract for them to look at, review live in that environment. We think this is an amazing way to scale what is a massive market of small projects that otherwise wouldn't be very economical for our direct sales team to focus on. To give you an example, we have a market opportunity of 5,000 mid-sized contractors out there. If we were to engage with 100 contractors who did 2 projects a year each, we could be looking at revenues in excess of 80 to 90 million. So we have this as a proof of concept at this stage. We haven't forecast it, but it's one of our growth initiatives we're looking to prove and come back to the market with some evidence early next year, and hopefully we'll be able to scale that to the SME market. And then finally, what we're looking to do now is having acquired nearly 400 schools, we've got a live customer base in contract. We're now looking at a proof of concept with another form of as a service, and we're looking at heating there is a really big opportunity in driving down heating costs for schools, and we're looking at air source heat pumps and ground source heat pumps wrapped up into a heat as a service solution. We're currently doing a proof of concept project for Marlborough College, which is, as you know, a very prestigious independent school. If that is successful, we'll then look to make a case to roll that out through our sales team to our existing customers. Talking about our buy and build strategy, we've talked about this being a very fragmented sector. We think the energy broker market, the TPI market, or the energy management sector, all one and the same thing, is misaligned with customers' best objectives. We think there is an opportunity to essentially drive a single point offering to either a school or a customer in the commercial space, which is procurement of green energy through a carefully monitored and measured metering solution that allows us to provide intelligence back to the customer that then drives energy consumption reduction through energy as service. Obviously, the best energy strategy is to use no energy at all. So the less energy you are using as an organization, obviously, the lower your carbon footprint, the lower your energy costs. The issue with energy management brokerages and TPIs at the moment is they're on a supplier pays model. So they are generating their revenues from essentially the utilities companies, and therefore they're not incentivized to drive down consumption because they're paid on consumption. We're looking at some tech-enabled energy management companies at the moment that have a different perspective on how to drive value to their customers. We're looking at businesses that are profitable, that generally have between 1 and 3 million of earnings. We're looking at multiples between generally 5 and 7, depending on the level of complexity and the level of technology investment they've got. We're looking at the customers that they have as a cross-sell, upsell opportunity for the eLight and eHeat solution that we have. So we're moving very much to an M&A strategy, which is about centered around energy management as a service generally, that includes procurement, measuring and monitoring, and energy reduction. And we think that may also lead us into energy generation, which could be the acquisition of solar assets for schools, but that may come at a later date. So we have a mature pipeline of opportunities in this space where vendors are excited about our proposition, excited about our strategy, and they can see the combined vision that we have, and are very motivated to take a mixture of largely paper-orientated consideration, but also small amounts of cash in potentially an earn-out scenario. We did complete our first acquisition in June of this year. So we acquired Renewable Solutions Lighting, which was our only real competitor in the education space. RSL were known as a specialist in the multi-academy trust sector. We acquired them for an all-paper deal. In the first quarter, they've already hit 75% of their annual target and are looking to have met their target within the first half of this year. So they will be a very earnings accretive acquisition, and we're very excited, and the implied earnings multiple on that deal will end up being 3 or 4 times. So it's a really value add complementary acquisition, and we've integrated their team. We now have an operations hub in Bury St Edmunds, which is serving as our eLight training academy for our eLight app and our eLight contractors. So it's worked incredibly well, and I would say that the impact of COVID has been minimal to our business, largely as a result of the focus on schools. As most of you will be aware, during lockdown, the schools were kept open for key workers, which essentially meant that we had access to site, and we were able to work with schools that had less pupils in school than normal. So we were actually able to get quite a lot done, and that's been a good opportunity for us to expand our business.
Harvey,
a little bit about
Harvey, sorry, it's Roland here. Sorry to interrupt. We're a little bit over time, and I do have some questions here. If I ask you to kind of to summarise or to kind of get on to the summary, so we have time for a few questions before we finish.
Absolutely. Yeah, absolutely. So I guess Q1 update, we delivered 4 million in the first quarter, 6 times comparable year on year. We've seen significant uplift in new business, 350% growth, positive monthly EBITDA, and we secured a successful project fund of 15 million to fund our Irish business. So we're expecting to be on track for making our break even by the end of the year.
Well, let's go to the top of this section here. Do you have any recurring revenues, or are all revenues purely a one-off, the sale of those lighting projects?
I'll answer that one, Harvey.
Is that for who's answering that question, Rick or myself?
Up to you.
Rick, would you like to answer that?
Yeah, the bulk of the light as a service business, the E-Light business, is securing projects. But actually, once we have secured a client, then there is the opportunity for selling additional services through. So as we broaden the energy efficiency as a service offering, our existing clients where we've installed the light as a service is a natural target audience where our reputation is already established. So currently it is project based, but we are migrating towards services.
Thank you. Next question. The business operation appears appropriate for a franchise model, which I guess is similar to the app that you described. Do you have any plans to move into franchising?
It's a very good question. The answer is yes, through this licensing model. So what we're looking at doing is creating a licensing franchise by postcode for regional contractors to sell to small SMEs and primary schools.
Next up, are all customers signed up for 7 years, like in the example you showed us, or are there options to sign up for different periods, 3, 5, 10 years, and so on?
So the bulk of all our contracts are 7 years. We do sign 5-year deals in the commercial sector, but 7 years is generally 80 to 90% of all our contracts in the education sector.
And do those customers then own the hardware in lighting in this example at the end of that 7-year period or whatever?
Yes,
period?
they do. At the end of the 7 years, there's a transfer of use where there's no further fees, and there is the option to extend through a secondary term of effectively service and maintenance to E-Light. So we do expect to get a secondary income stream in years 8 to 10.
And I guess the question about kind of the kind of historic lighting solutions in schools, and they're not using tungsten filament lights anymore. Presumably, most would be using fluorescent tubing or similar. What's the equivalent, the lifespan for LED lighting? How long do these things last for? After that 7 years, what's the remaining life expectancy of the hardware installed?
So the technology we deploy has an expected life of 20 years. We have warranties in place for 10 years, so that allows us to be comfortable for the first 7 under our ownership, secondary rental income for years 8 to 10, and then the school can expect a further 10 years of comfortable use out of those lighting. And it is predominantly fluorescent replacements.
And the question I had, and I've got a few more, but just come back to the kind of the model around energy services. When you're coming onto the market and explaining to investors, potential investors, what you do, I can't think of any other listed propositions, which are directly in your peer group. Was it difficult getting the idea across? Have you found the reception in general since being a public company?
It's been phenomenal. I guess we do have a peer group in Inspired Energy that is an aggregator of traditional energy TPI management businesses. We're coming at the business from energy efficiency first, which is consumption reduction first, followed by procurement of green energy second. The appetite for investors has been overwhelming since we've announced our results. We've been back to back for the last 2 weeks, speaking to 5 or 6 different investors every day, and I think our goal is to get more institutional investors in our stock, so that we've got more firepower if we do find larger acquisitions as we go through our growth period.
And I had a question on that again on the composition of the register. What does that look like at the moment? What's the management owning?
Yeah, so look, founders and management have got circa 65%. We've got 15% held by principally 3 institutions, and then we've got about 20% held by retail stock owners. So yeah, look, it's a pretty good mix. Share prices not quite where we want to be. N1 Singers have done a great job of producing a research note recently and have given us a target price of 12p. So we think we've got a lot of opportunity now to start seeing some value creation.
Okay, next is about liability. After you sell the contract, do you have any future liability for the payments, let's say from the school, if they default or stop paying?
No, we offset, so all of the financial credit liability sits with our funders, so we have no recourse from a credit perspective. We offset all of the technology to our warranty providers, and we accrue for any O&M operations and maintenance should we have to support and project manage any lamp failures. I mean, it's interesting, so after 1,000 projects, we don't have a warranty department. So we have seen less than 0.5% failure in our total luminaire portfolio. So that gives you some indication of sort of the quality of the equipment we're putting in and the quality of the install we're putting in.
And I guess there's a question here about future expansion. Any plans to move away from the UK? I think you've probably got enough to go for already, haven't you? Any plans for what you might do, geographic expansion?
Look, we have. We've been approached by a number of very exciting businesses in Australia, in New Zealand, in Europe. You're right. We've got a very clear focus for the next 12 months. We do think there is an international opportunity as we franchise our business model, because our business model is now vertically integrated with both finance, technology, contract, and I guess process through the app. We are able to provide a very unique opportunity for international businesses to effectively leverage customers or leverage their geographical regions.
Okay, gentlemen, Rick, Harvey, thank you very much indeed for joining us this evening.